Good morning, ladies and gentlemen. This is Dr. Joseph again with Finance Hub. I am an investment banker, a chartered accountant, a finance professional, and an economist with about 20 years experience in the financial industry in Nigeria. Today, we are going to look at project financing. What is project finance? Why is project finance necessary? In the course of my working career, I observed a lot of project failures. And what was the reason? Major reason for project failure is cash flow mismatch. So most people get projects, they run to the commercial bank, they collect the loan to finance the project. The project is a long-term project, but the commercial bank actually gives short-term financing. So from day one, there's a cash flow mismatch. So because of that, a lot of projects were abandoned, and people that ask the project abandon the project. So project finance is a very interesting topic, and it's something I like so much because we need to help people to know when do you actually use balance sheet financing and when do you actually go for project financing. So what is project finance? Project finance is the finance used to finance a project. And these projects are usually long-term in nature. One of the peculiar things about project finance is that in repayment of that project, it is the cash flow from the project that is expected to repay the loan or the capital you use to finance the project. So meaning that before you even undertake that project, you'll be able to know what are the cash flows. How much are we expecting from this project? If I go to take financing for this project, how much am I expecting? Can the revenue from this project or the profit from this project repay the project? So this should be determined ab initio before you take up the project. But a lot of entrepreneurs, a lot of business people don't do this simple analysis. If you can't do it yourself, the financial consultants are available to help you. But you should know the repayment. Does this project have the capacity? If it has, fine, good. And one of the key factors of project financing is that there is what we call project finance with recourse or without recourse, where the repayment is solely tied to the project. For such projects, you form an SPV. So take, for instance, the Dangote project. We're listening to Dangote's a recent time, and he said that I funded my project from my balance sheet, the refinery project, not project finance. That if it was project financing, possibly could have. Why did he make that statement? So there's what we also call balance sheet financing. In project financing, you actually do what we call an SPV. An SPV is called a special purpose vehicle. So you spin the project from the business and face the project. So you look at a project as an entity and viability of the project. If the project is viable, you go for it. If it's not viable, ab initio, you don't go for the project. Recently, a client called me and said they want to acquire a houseboat from the US, and it's going to cost an amount of money. But now the project is to be financed using project finance. So he said that you run a financial model to know if this project is going to be viable. And we run the financial model for him using the cost and the expected revenue of the project for the period of the contract. And it was viable. So if you don't do that, you can go into a project without knowing whether it is viable or not. And because if, for instance, if this project, for whatever reason, in the course of the business, you couldn't meet up with the project and they liquidate this project, can he actually repay the remaining loans? So under project finance, whatever they recover, even if he cannot pay the loan, they cannot go back to the personal property of the promoter or the business. So, but if it is a project with recourse, if the promoters are unable to actually make the repayment and they also dispose of the project and the project is unable to offset the liability, they can come to the companies to say, pay us our difference. But if it is an SPV, the lenders cannot come to the company. That is when the project is with recourse. There's what we call balance sheet financing, even when there is a project. So in balance sheet financing, what company does is that even though there's a project, they go into the project as a company, not as a project now. So the company go to the lenders, to the investors, or to the alternative finance institution to say, we have a project, but give us this money. So the lending is not based on the financial model of the project, but it's about the balance sheet and the capacity of the parent company. So they lend to the parent company, the company finance their project. Whether it is profitable or not is not a problem of the lenders. All they know is that this company is liable, they are going to pay us. So that is the difference between the financing a project using an SPV or financing a project using the company's balance sheet. Then what are the characteristics of project finance? One, it must be high project. A project must be highly leveraged. One thing about project finance is that sometimes the equity contribution of the promoters is small. So there's a lot of debts to finance this project. So, and it needs long-term debt financing. Like I said in the intro, one of the reasons why what I saw in the course of my career why project failed is that there's usually a cash flow mismatch. So you cannot have a project that you take 5, 6, 7 years to execute, and you're going to a commercial bank to give you money to fund your project. You are going to have a problem because the commercial banks are money market institutions and they are short-term in nature in terms of their lending. So you must look for long-term capital to be able to fund your project, because that's what will match the cash flow of the project, especially if it's a project without recourse. Then one of the characteristics of project finance is that the earnings, the revenue are reversed. So if you take a lending for a project finance, whatever is the revenue coming from that project is going to actually fund the repayment of that facility. So it's reversed. You can't use the money for any other thing. Then it is also long contractual agreement. There are a lot of agreements that are being written to make sure that the project finance is properly done before monies are released to people. So why the organization adopt project finance instead of balance sheet financing? To limit sponsors' liability. Now, if you go for project finance, like I said earlier, is that if the project fail for whatever reason, or they are unequal to actually meet up as they're supposed to be, you cannot go to the liability of the promoters. It's tied to the project because the project is an SPV or is a corporate sole on its own. So limited liability on the part of the sponsors. That is one of the reasons why people go for project finance too. To mobilize large scale funding. So you can use the project strength or the project strength to be able to go and raise funding. And again, if you use project to go and look for money, it also increase backability of the project. So how do we raise funds for project finance? One, like we said, you actually have to put down your equity. They usually it's on the small size. Then the debt. There is through debt, through a BPP, public-private partnership, is a very good way of funding project. The government have been using it in recent years, and it's fantastic. Then you can issue infrastructure bonds. They are also good for project financing. But the good thing about project financing is that before you go into project financing, make sure the project is viable. Thank you. See you in the next episode.